Hey guys, hope y'all are doing well. Back with another Saturday video. And I've actually talked about this before, but I believe I talked about it within a video. And I think this deserves a video on its own. Now, I've had a couple of comments asking about, QYLD, the NUSIs, the JEPIs, all that, when they pay a return of capital, where is the best place to buy these products? Now, the correct answer is it depends, right? But we're going to go over some things about retirement accounts, and we're going to go over some things about the return of capital that some of these pay and how to find them. So, hope you enjoy. If you do, like, share, subscribe, do all that good stuff. Also had some comments that I talk too slow. Well, I don't know what to do for you there. Maybe you need to listen a little slower. Maybe you're listening too fast. I'm going to be me. I'm going to do it the way I do it. And a lot of you guys know, no script, no timer. I have no idea how long these are going to be. They can be 20 minutes. They can be 8 minutes. They can be whatever they're going to be. Is when I get my point across is how long it's going to be. So, I don't worry about timing or speed or anything. So that's just the way I do it. So anyway, like, share, subscribe, do all that good stuff. Down in the comment below, linked comment below, are ways you can support the channel. There's Amazon affiliate links and all that good stuff. And before the end of the year, M1 Finance still is giving away $50 for new accounts if you use my link below. Great idea for Christmas. So let's get into it. I have an idea what I want to talk about, and let's see if it works out smoothly. So now, we're going to first talk about retirement accounts, right? For the most part, there's traditional IRA, there's a Roth IRA, and I'm using this graphic on the screen right now to point out some key differences here, okay? With a traditional IRA, you pay taxes later, right? So you put your money in the IRA, and that's tax deductible in the year that you make the contribution, right? Now, what that means is your investments grow tax deferred, and when you withdraw your contributions and earnings during retirement, you pay income taxes on everything that comes out of there, okay? So everything that comes out of a traditional IRA is taxed at whatever income rate you're at the time, okay? It could be very little. It just really depends on your income at the time, tax rates at that time, those types of things, right? Okay, so this is important. Keep that in mind. Traditional IRA, you pay taxes later. You will always pay taxes later. With a Roth IRA, you pay taxes now. So what that means is you make after-tax contributions to your IRA. So when a traditional, you get to deduct that income off your taxes in that year. With a Roth IRA, you're spending, when you get your paycheck, you're spending whatever your net pay is, and you're contributing that to the Roth IRA. So that money has already been taxed. Okay, so now your investments grow tax-free. Okay, now when you withdraw your contributions and earnings during retirement with a Roth IRA, typically it's 59 and a half years old, you pay zero income taxes on withdrawals. Okay, now we'll shelf that right there, and we'll look at QYLD, right? I'm going to use QYLD. There's RYLD, there's XYLD, there's NUSI, there's JEPI, there's DEVO. These are all going to be a little bit different than what I'm talking about. So I'm really just concentrating on QYLD, but I'm going to show you how to find out whether return of capital is advantageous to your investment. Now, you go to the Global X website, you go to our ETFs, right? And we'll just click on QYLD. Now, for those that don't know, return of capital is essentially a way for an ETF provider to classify the distribution they pay you to reduce taxes, right? So let's look at it. So to find out if your fund is paying return of capital, please do not rely on your broker. Your broker will typically have it totally wrong. Okay, go to the fund owner's website, and in this instance we're on Global X. Click on the ETF in question. This one we're doing QYLD. Look for documents, and what you want to look for is supplemental tax information. Let's click on that. You'll open a new one, and right here they have a link right here if you want to do it. They list them all, but here we're going to look at just QYLD. Now, the form that is important here is the official form, which is Form 8937. We don't have one for 2021 just yet, but Form 8937 is the official tax form that is sent to the IRS to designate whether their distributions are going to be classified as a return of capital. And let's just open it up and look at it. So it is a report of organizational actions affecting basis of securities. So we'll go down here. Here we go. The amount shown as a return of capital distribution in the attached statement represents a reduction of the shareholders' tax basis on shares held. So in other words, let's say QYLD was $25, and throughout the year they sent you $1 of return of capital distributions throughout the whole year. Your cost basis in that stock is now $24. Okay. Now, since it is classified as return of capital, you cannot be taxed on that income because you've already been taxed on it, right? You've paid with it and you've bought it. They're returning your money, and you can't be double taxed on your money. Now let's see. The portion of a distribution which is a dividend is includable in gross income. Pursuant to the IRC section, the portion of the distribution which is not a dividend shall be applied against and reduce the adjusted basis of the stock. So if there is a dividend, then it will be includable in income. But if it's a distribution of a return of capital, it will adjust the basis of the stock. Okay, no loss would be recognized on the return of capital distribution. The shareholder's cost basis should be adjusted to reflect the return on capital distribution, which may affect realized gain or loss upon disposition of the shares. So if you were to sell, right, so that example I just gave where it was $25 and they gave you $1 of distribution, right? Now your cost basis is 24, but it's still selling at 25, let's say. If you sold that, you would have to pay taxes on that dollar difference. But if you never sold it, then you would never be taxed. So that's why I always say that a lot of these income funds are like never sell type products. So if we go all the way down, we'll get to see in 2020, it only has 10 months here. I'm not sure why on that one either. But you'll look at the percent return of capital distribution, 100%. So none of these amounts here can be taxed because there are return of capital. So with that being said, and we go back to here, which fund would you say is the correct place to have QYLD? A traditional IRA where you pay taxes later, or with a Roth IRA where you pay taxes now? And the answer is, as long as the return of capital distribution is 100%, the answer is neither. Neither. That's the caveat though, as long as they continue to pay return of capital distributions, if you were to hold this in a traditional IRA, you will pay taxes later. So in other words, QYLD is a tax-free investment at this time, but if you had it in a traditional IRA, when you go to withdraw it, you will be paying taxes on those withdrawals. So essentially, you're turning a tax-free investment into a taxable one in a traditional IRA. Now, with a Roth IRA, it's kind of a wash, right? The thing is, you cannot take advantage of what's the better way to put it? You're not putting your Roth IRA in the best advantage because you're not taking advantage of the QYLD and its cost structure and its tax benefits. You're kind of wasting your Roth IRA if you were to put QYLD in there, since it is a tax-free investment anyway, as long as, caveat again, as long as they continue to pay return of capital distributions. It is not guaranteed that they will continue to do that, but so that's kind of a gamble you'll have to play, right? Like if they go to not paying return of capital distributions, then that could affect you, right? So there you have it. Where's the best place? If they continue to run a return of capital distribution, the best place is a taxable brokerage account. Why? Because it's a tax-free investment, and if you put it under a traditional IRA, you'll turn that tax-free investment into a taxable one. If you put it into a Roth IRA, you're kind of I don't want to call it disqualifying, but you're not taking advantage of the growth of investments of being tax-free within a Roth IRA. It's probably better to have more qualified dividend stocks in a Roth IRA, even growth stocks in a Roth IRA, bonds in a Roth IRA. But a investment that pays 100% return of capital is really best held in a taxable account. Now, I probably talked very slow, and this probably went on way too long, but I just wanted to get that out there. Everybody's different, right? You got to figure out what you want to do. With these return on capital things, that's what you have to look for. Form 8937. Form 8937. If you can find that on the issuer's website, that's the official form. Don't rely on your broker. That's it. Hope you guys listen fast enough. That's just funny. I hope you guys enjoyed. I probably missed a bunch of stuff because, like I said, I don't go off a script. I don't do any of that. I know what I'm thinking, and I try to put it all into words and make it understandable. So, hope you guys enjoyed. Like, share, subscribe, do all that good stuff. Leave me a comment down below, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.